thank you for giving me the opportunity to chat. I see a lot of familiar faces. I'm going to walk through a little bit about FundThrough just to remind everybody what it is that we do, and then I'll give everybody an update on what's been going on over the last year. So our mission is to empower small businesses to thrive, and we do that by bridging that cash flow gap between when you invoice and when you get paid. We've added to our mission this last thing, this more specifically, which is ultimately we want to end up being the pipes, the rails, if you will, that enables B2B invoice payments, business-to-business invoice payments to occur. And I'll talk a little bit about what that means as I go through the presentation. So what is it that we do? The best way for me to describe what it is that we do is by telling a story. When my grandfather was alive and working, he was manufacturing coats. So he would manufacture a coat and he would sell the coat, and the buyer of the coat would give him, his dollar, and he would take the coat and they would go their merry way. Then over time it became, I'm manufacturing the coats, and the buyer would say, great, give me the coat and I'm going to give you the dollar in 10 days. And then that 10 days turned into 30 days. Now the average across Canada is 60 days. And it feels like at every time there's a financial crisis, that time period during which small businesses have to wait to get paid from their much larger customers gets longer and longer. And we just don't think that that's fair. So at the core of what FundThrough does is evening the playing field, putting the control back in the hands of the small business, so that when a small business issues an invoice to a much larger customer and has to wait 60, 90, even longer, 120 days sometimes to get paid, they can click a few buttons, we will pay them today, and we will wait on their behalf. And then we will get paid according to their normal contract terms by their customer. What we often say is that we don't take performance risk, we take time risk. So in other words, we are only funding invoices when they are legitimate invoices. In other words, you have done what you were supposed to have done, that you've committed to have done, either deliver the service or deliver the product to your customer, and your customer agrees that you have done what you said you were going to do, and agrees that the product that you've delivered or the service that you've delivered is of the quality that they have expected, and now they're just waiting. That's where we come in. That's that gap that we're filling. The way we go to market is unique. We go to market not by taking out bus ads, which is why many of you may not have heard of us, or by pay-per-click Google ads or Facebook ads. The way we go to market is by integrating directly into the source where invoicing happens by small businesses, predominantly in three categories. One would be invoicing software. We have a de facto exclusive partnership with QuickBooks in Canada. So if you know anybody who uses QuickBooks and invoices other businesses, not consumers, but other businesses, they will have likely seen FundThrough in some way, either through a pop-up or a dashboard thing, or a button, or some email marketing from Intuit. So we'll go direct through the invoicing software. Another platform that we'll go through is AP, accounts payable automation software. So we have another partnership, you can see it on there, Inveris. It's probably a company that none of you have heard of. It's niche in the energy space. So if you are a small supplier, somebody who's digging the hole or hauling rock or building pipelines, and you're doing it for some of the largest oil and gas and other energy players in Canada and the US, you're likely receiving your work orders and purchase orders through this platform. And likewise, you're issuing your invoice through this platform. We have a deep integration with Inveris that when you issue your invoice to an approved customer, so somebody that we know is somebody who is going to pay, they're creditworthy, a button will pop up. And all you have to do is click that button. It'll take you to us, and you can get that invoice funded. And then the third way that we go to market is by integrating with B2B, business-to-business marketplaces. There's this wave that's happening where commerce is moving online. It started first, obviously, with e-commerce and business to consumer, but it's also happening in the business to business realm, where everything from chemicals. You'll have small suppliers of various different chemicals and large, whether they're fragrance companies or food companies or industrial companies, making those matches on the platform. Well, the platform wants the transactions to stay on the platform, and one of the ways to make that happen is to make it more sticky by adding funding for those invoices within that platform, and that's where we come in. The proliferation of B2B marketplaces is massive across North America, across the world, but our focus is in North America, and our focus is to be embedded everywhere within them. So the benefit to the partners is that it creates stickiness, it's easy, there's a new revenue stream. We tend to compensate them by generating a rev share for them. For every dollar that we generate in revenue, we'll pay them a small vig for the right to do it. It benefits us because it lowers our cost of acquisition, our CAC. Because we don't need to go out and spend variable marketing and try to find all these small businesses across North America, we know where they are. We just have to, be integrated to get it. And it benefits the users because they never have to leave their workflow. And this is a really key thing. A lot of our users don't even think that they are factoring. For those of you who have heard the term accounts receivable factoring, that's effectively what we're doing, tech enabled. But they don't think that that's what they're doing. All they're doing is getting paid early. The competitor for us is giving a discount to your customer to get paid earlier. And I'll often stand in front of conferences and I'll ask, and if it's a conference of small business owners, I'll ask the question, have you ever given a discount to your customer to get paid early? And sure enough, almost all hands usually go up in the air. And I'll ask the next question, I'll say, just yell out ranges of discounts that you might have offered to your customer. And I'll hear anything from 2%, to 10%. And it's almost shocking when people say these numbers because they don't understand what the annualized rate is. If you were to actually annualize what the rate is, 2% net 10 on standard 30-day terms is 36% annualized. So we always say, don't do that. Come to FundThrough. We're much cheaper. We're much easier. It's right within your workflow. You don't have to get your customer involved and negotiate a discount with them. Oftentimes, you'll negotiate a discount with your end customer, and they'll take that discount, and they'll still pay you on the terms that they want. So you've just given up some margin. So that's some of the way we go to market, and it's sort of a win-win-win situation. Where we ultimately want to get to, though, our North Star is to become this Rails. And the analogy that I give here is when you go into a supermarket, you collect all the stuff that you want to buy, you go to the checkout, and there is a magic box there called the credit card terminal. This magic box, when you swipe your card, tells the merchant that this customer is creditworthy and you should let them leave with the goods because you will know that you're going to get paid. We want to be that magic box in the reverse so that when you issue an invoice and you send it through FundThrough, we will know that that invoice is real, that the invoice is going to get paid at the right time, at the right place, for the right amount. And by doing that, we can get ourselves out of the capital game and into the technology game. Right now we're a fintech, but fin is really important. We have a balance sheet, which means that we are beholden to when interest rates go up, or we're beholden to lenders needing to provide us with capital that we can then lend out. In order for us to get to this Rails concept, almost like the MasterCard ecosystem. If anybody knows how MasterCard works, it's a fabulous business model, and it's a very high margin business model. And we think that we can get there by doing it on the B2B invoicing side. And basically deconstruct all the components. Right now we're doing it all, from origination to underwriting to the actual lending to the monitoring to the collections, all ourselves. But if we just took some of it out and took sort of the high margin part of it out, we could charge a fee instead of an interest rate along the way. That's our North Star. That's where we're going. So each year when I come and present here, hopefully we will be 1 year closer to that North Star. Now, the beauty of a North Star is that it is always often in the distance. So we, in addition to a North Star, come up with our North Pole, which is our 5-year goal. And our 5-year goal is to be $100 million US in revenue, $10 million of operating profit, and various other things that get us on the way to getting here. So, all that is to say, this last year has been quite interesting. As a tech company that, as I said, is reliant on outside capital, both equity and debt, I'll talk about the debt for a second, it's been a fascinating time. I stole this line from one of my competitors where I quarterly speak with him in the US. He's runs a Silicon Valley-based, he's in a slightly different space, but also a sort of a fintech lender, much larger than us. And he said, you know what, surviving is the new thriving. In this world, up to this point, being sort of summer of 2022, the focus was always on top line. Our businesses were valued on top line, still valued on top line, but crazy multiples, and it didn't matter what was below the line. Well, I have the easiest business in the world to generate revenue. Everybody wants my product, money. Where it becomes really difficult is trying to get that money back. And that's where we are good. That's what we have focused on right from the very beginning is, building that infrastructure to be able to underwrite, monitor, and collect, and then building these channels to be able to originate, because it's just not enough to originate. A lot of our competitors raised a ton of money out of Silicon Valley primarily, and along with coming with that money meant grow. But there's only a natural point where you can grow in this business before you start scraping the bottom of the barrel in terms of creditworthiness. Strangers on the internet looking for money late at night, not good credit risks, generally speaking. So, but they had to do it, and they generated revenues and eyeballs. It's like going back to like the .com days, where instead of eyeballs, in this case it was revenue, but they were losing multiples of revenue in terms of in profit. At the same time, for us, we were seeing interest rates go up at a really fast pace. Obviously, everyone has experienced that. But this was the first time in our business that we had seen that happen, which means our margin was compressed, our cost of capital went up, and we started to realize that if we passed this on to our clients, we were going to start to see some negative selection bias, which is those that needed us most would pay anything, and they're the highest risk. And those were not the types of clients that we wanted. So what do we do about it? We said, okay, well, we're going to focus instead of just on top line growth, we're going to focus on getting to profitability, because if we can get to profitability in a high interest rate environment, imagine the cash that this thing will spit off when interest rates eventually do come down, or when we are able to refinance our loan facility, even in a high interest rate environment. So our path currently, our biggest cost of goods is our loan capital. Our path, we're 9 years old now. When we first started, we had friends and family. We moved to sort of wealthy family office. Then we moved to an institution, a debt institution, Northleaf Capital, who's a local player here. And that's who we have now. And the next step is to move to a bank and continuously bring down our cost of capital. And when we bring down our cost of capital, it's as a margin, as a spread to SOFR, which is the new LIBOR, which is how our pricing is set. So even though SOFR is going up, our spread should come down, and that should help us. So by focusing on profitability, that'll help us get to that stage. The other thing that we did is we deepened the partnerships that we had with our existing partners. The way for us to really grow is twofold. One is grow what we call the GMV, the gross market value, which is how many invoices are connected to our platform. We want more clients and more invoices connected to our platform. And then the second thing is, what's the penetration of those? So for any client, or first, for any client and then for any partner, what percentage of their invoices or what percentage of their users are using FundThrough for what percentage of, the broader user base. So by deepening our partnerships with our partners, we're able to get deeper penetration as well as expanding GMV and provide them with more of a rev share. So it's a win-win for both. The other thing that we did was we narrowed our funnel, so that we didn't focus on this bottom of the barrel that we're talking about. We said we are willing to do fewer deals, fewer clients coming on board, as long as they are higher quality. So, focus on, profitable growth rather than just growth. And then the last thing that we did was we raised additional equity to have it on our balance sheet. And in this weird world that we're in, I know I'm talking to a group of finance folks, and I am myself am a finance folk. I believe in our company that equity is actually cheaper than debt at this point in our development. Why? Because my finance professors would be like screaming at me, like that goes against every theory out there. But the reason is that by raising equity, I can capture margin. Instead of using debt to fund, I can capture and paying a rate on that debt. I can capture that margin. I can then use that cash to reinvest in growth of the business, and it increases enterprise value. That's the rationale. Here's where the plug comes for Urbana. This equity round would not have been possible if it wasn't for Tom and Brendan. They recognized this, and they said, okay, we support doing an additional round, and by doing that, we were able to unlock a really large investment, a $10 million investment from a Canadian growth equity firm called Canadian Business Growth Fund, CBGF, who are great partners. And it would not have happened if Urbana didn't step in first. So, just as for anybody who may be looking at getting an investment from Urbana, they really do add a lot of value. So that's what we did in the last year. And we've transferred from surviving back into thriving. And what's beautiful is many of our competitors have blown up. The white space has gotten wider. We have more cash on our balance sheet than we have ever had before. We have the best team we have ever had in the 9 years since we started. And now we are ready to do, and we're doing all the right things to build the foundation so that when the world comes around to us, we will be able to accelerate. The interesting thing is, in an economic downturn, our business tends to outperform. Why? Because large customers take even longer. They want to hold on to their cash even longer, so they make their small suppliers into their bank, essentially, and they hold on to cash longer, so their payment terms get extended, and other options dry up. Banks no longer lend, they tighten their criteria. So that gap gets wider, and that becomes a better opportunity for us. We've never experienced in my lifetime a situation where you're going into an economic downturn and inflation and interest rates are going up. So that's a bit of a headwind that we have to manage through. The beauty of inflation in our clients' business is that the invoice sizes are larger, which means that we fund more, but business activity is declining. We're a bit of that canary in the coal mine because we have access to so many connected invoicing and this relationship with QuickBooks, which is the largest small business invoicing software across North America. We can sort of see patches of softness, invoicing going down in certain industries over time. So that may be that leading indicator that we are starting to see that slowdown. They've been calling for this recession for over a year. So who knows what happens, but it doesn't matter. We're building a strong business that'll be able to survive and thrive through any environment. So what does that look like? Just wanted to share very, very quickly. We closed our year, June is our fiscal year. These are all US dollars with $25 million of revenue. So we were still able to grow year over year, and we anticipate we'll continue to be able to grow. You can see, though, it is more managed growth, and that's intentional. And when the time comes, we'll push our foot on the accelerator again. I often say to investors that we are the tortoise and the hare story. It'll often be said to us in investor meetings, why can't you be more like, I'm not going to name some of the competitors, this company that just raised money or that company that just raised money. And I'll say, look, they're probably smart. I don't understand their business. All I know is our business. And I know if I keep our head down and just focus on our business, we'll be able to succeed. And sure enough, we are building that foundation. They all flew by us and then they all collapsed. And here we are methodically, passing each of them. So that's all very positive. I would be remiss if I didn't end by asking for something. So I would really love if any of you know anybody who could use our services. Brendan is amazing at this, and being able to refer folks that he knows who might be able to use our services. Please send them our way. Any partners where we can integrate, we'd love it. Any investors, either on the equity side or the debt side. Talent, we've got an amazing team. It's a great culture. Everybody loves working there. And we like to find places for smart people, regardless of whether or not we have open roles. And the last thing is, please, please, please talk about FundThrough. One day I'm going to come to a conference and I'll ask the question, who here has heard of FundThrough? And everyone will be like, oh yes, I know it. My neighbor uses it. My partner uses it. Everybody I know uses it. We're not there yet. So we have some work to do. With that, I will turn it over for questions.
Can I go back to your example in the supermarket with your MasterCard example?
Sure.
I get the financing, the transaction with both money and the technology. Your North Star is to not have to do the financing, just do the technology. So I go in with my FundThrough card to Loblaws, I spend $100, they get their money. Who's financing that transaction? Where's the money coming from?
Yeah, so ultimately it won't be a FundThrough card because it's not a consumer type product. It is a supplier issuing an invoice to a larger customer. And then if I look at society, the best people to fund this are the people with the lowest cost of capital. Who are the people with the lowest cost of capital? Banks or insurance companies. If I can prove out that our underwriting, our origination, our monitoring, and our collections all are great, then they can plug into the system. And if I have an open pipe, I can allow anybody who has a technology idea to be able to build on that. In the same way MasterCard themselves don't lend, but banks lend against credit cards, or banks offer the credit cards, we could do the same thing for small business invoicing.
Yes. Do you ever, like in this town, there's a lot of people doing renovations on their housing, and some of them have really got gypped on it because the contractor was there, and then once he got the money, he more or less deserted them. Would you handle anybody like a individual that just wants to renovate his house, let's say in Toronto, for $500,000, and he wants you to act as the intermediate between the contractor getting paid when something's delivered on time or not? Would you be too big for that? Would you do it?
So our sweet spot is business to business, and it's really business to larger business, because that's where they're getting taken advantage of. We don't do anything to do with consumers, so we don't do any personal loans. We're not. That's a whole different area of regulation and credit and all this kind of stuff. And we tend not to do small business to other small business. So landscaper, or in this case, contractors to, or a landscaper to a contractor or something, is not our sweet spot. It's more large invoices to large customers. So unfortunately, we wouldn't be able to help in that situation. Yes.
Thank you. So Stephen, let's assume I'm a small business and I work with you and I get paid so much faster than I normally. What's this costing me? What's the percentage?
Yeah, so the way we charge is in the same way you would get charged by a credit card if you were to accept credit cards. But you're selling to customers who won't accept credit cards and are going to pay you by check. So you're used to paying 2 to 4% of the transaction value on your credit card to be able to get paid faster for people who want to use a credit card. We charge 2 to 4% of the invoice.
On the subject of credit worthiness, what is the mechanical means by which you do get paid? Presumably the invoice does not say larger, my debtor, please pay FundThrough.
Yep.
It presumably does not say that. So logistically, how do you get paid? And secondly, would not the party to whom you're providing the financing can they not go to the bank and work the same mechanism by way of doing a receivable transaction
Yep.
with them?
So, okay, the answer to the first question is about 85% of our transactions, we do get paid directly from the payor. So the invoices will say, you pay to FundThrough.
Okay.
That's done through what's called a notice of assignment. So when you get onboarded with us the first time, you issue this notice of assignment along with the invoice to your customer. And the notice of assignment basically says, I've sold this to FundThrough. FundThrough's my partner. You have to pay FundThrough. If you don't pay FundThrough and you pay somebody else, you have not discharged your liability. That's a really important legal document that's actually been litigated up to the Supreme Court. It's really important because the nature of our business enables us to give you funding when you yourself are not, you as a small business, are not creditworthy. We're enabling this funding off of the creditworthiness of who you sell to rather than who you are. And in order to do that, we need to get in the middle of the payment, because the moment the payment hits, you've already been paid for the invoice. If you get paid a second time for the invoice, who knows where that money is going to go. So that answers a little bit, that answers the first question. As to the second question, it's really the same answer, which is our user base tend to be small businesses that are asset light, don't fit with a bank criteria, and therefore are not able to get a bank. If you're able to get a bank loan or a line of credit or something, we encourage you to go and do that, and then to come to us. We can work with a bank, and then come to us, and we will sit behind the bank. Because the problem with the bank is they're going to give you a facility that's based on what you did yesterday. Our core client base, the ones that we love, are the ones who are the hustlers, the ones who are working really hard, and they get that big order. So they're looking at the future. So they may be doing $100,000 a month in revenue, and then they get $1 million order from Walmart. And the bank can't keep up with that. We are forward-looking because we're looking at your invoices. We're not looking at your history. Brendan.
So two things. One, just to give you the idea of the problem, I did a little business case study on Apple, which pays its suppliers between 90 and 120 days for anything they do for it. So up to 120 days. Do you know how long Apple holds the iPhones or anything else it makes in its possession? Its inventory turnover is 4 days.
Yeah.
Apple doesn't do anything. It's just a bank
Yeah.
borrowing from these
Suppliers.
smaller businesses, because everything's smaller than Apple, holding products for 4 days, sending it out to the general public, and sitting on a mound of cash like some sort of technological Scrooge McDuck. So Stephen and his partners in this business make it possible. I mean, that's just an Apple example for smaller businesses all over this continent to actually get paid in a reasonable way. So that's the first thing. Second thing, if you have a smaller business that you know and are involved with, my personal experience in referring clients to Stephen has been excellent. A close personal friend had a multi-generational family business, and he got his, what's the nice way to say, his backside in a ringer, something about furniture somewhere floating in the Pacific and receivables and things. It was insane. Whatever your friend's business is dealing with, it is not as insane as my friend Doug's issues. And Stephen was able to fix it. My friend would have lost his business, still has a business. Steve and his company made that possible. So that's just one example. Whatever your friend's business is dealing with is nothing like this, and FundThrough can probably help.
So what if your client is Trump Steaks? So how and the receivable goes to you? How is it dealt with? Because I come from a family of manufacturing, and I certainly know when the recipient of the goods doesn't pay. How does your business work in that case?
Okay, so so the question is, what happens if you fund an invoice and then the payor never pays?
Or pays 88%.
Or pays less, yes. At the end of the day, I'm being told to wrap up, so this will be the last answer. At the end of the day, we, as I said, are taking time risk and not performance risk. So it is your obligation to ensure that the invoice is going to get paid and that you've done. We can only do so much. You know whether or not the invoice is going to get paid. You know your customer. If an invoice doesn't get paid for some reason, the normal, and it does happen a lot, the normal ordinary course thing is that we would simply ask the client to replace that with another invoice, and they would do it. So that we would then, so it's no money off of their back. They already got paid on that first invoice. They would replace it with another invoice. We get paid on that invoice. That just happens as long as it's an ongoing business. In the very rare case that Target Canada or Nordstrom or something just decides overnight to wrap up, we do have an insurance policy against that.